Hey everybody, this is Bob Iacchino at Path Trading Partners. Thanks again for being here. Mike Arnold is here with me as well. Quick thank you to Chip and everybody at Nadex for allowing us to host this again. For those of you that heard our series on Nadex Spreads, we're continuing along the path, pun intended, of teaching you guys actually the best ways to look at these spreads and where and when to put them on. So this is trading the null point in Nadex Spreads. We'll be explaining exactly what that means. But first, as always, let's do a quick risk statement. Mike and I take this very seriously. We take it very seriously at Path Trading Partners, and Nadex does as well. So this presentation is for information purposes only and does not constitute investment advice nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. This presentation is not intended for solicitation purposes, but only for use as general information. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial conditions. Past performance is not indicative of future results. Just a quick 2 seconds on past performance is not indicative of future results. We're about to talk about putting on trades at what is called the null point in spreads. And we're going to talk about how it's more effective. This is obviously based on our research, which theoretically is past performance. But what that statement means, and it's extremely important to understand what that statement means, is that just because you have a pattern or a setup or a situation that we or anybody else has talked about as being high probability or very reliable, it does not mean that because it worked the past 10 times that it's going to work the next time you see it. That's what that means. So it's really a second level of risk warning for everybody. Don't think that because you found a setup that it's going to work as well as it did the last 10 or 20 or 30 times you've seen it. Always control your risk on every single trade. That's what that statement means. So what is Path Trading Partners? Path Trading Partners is a trading and education firm. PTP's mission was to form a trading firm that educates, supports, and backs and funds traders who are committed to probabilities, discipline, and long-term trading success. And this is achieved by following the correct path. That's where we got the name from. We are not high-frequency traders, and we are not day traders. What we are is a firm that believes in a long-term success in trading covering time frames dictated to us by products, markets, and price action. We don't go in with a mindset of, I want to trade X in Y's type of trade, right? We let the market dictate to us what we're going to do. That's what the correct path is. So who is Mike Arnold? Mike's a 24-plus year market veteran, and he's been teaching traders online and in person for 10-plus years. He has been, and still is, a strategy and development consultant to multiple large hedge funds. He's a former options market maker on multiple exchanges, and he's traded in Chicago, New York, Switzerland, and Canada. And Mike is the current head of technology and trading system development for Path Trading Partners. It's a mouthful. Who is Bob Iacchino? Well, he's the guy talking to you. I've spent the last 24 years in the commodities, futures, and forex markets, and I've been teaching and mentoring traders both live and online since about 2002. This is my background. I've been an analyst, proprietary trader, and a fund of hedge funds principal and a member of the investment committee in that fund of hedge funds. And that's where I think I bring value to our students as a member of that investment committee, because I've seen so many different methods and so many different levels of performance that I bring a level of understanding of track records and performance that can help you guys all down the road. To date, I've taught and mentored over 5,000 students, and you guys may know me from my television appearances. I've done over 700 so far, talking about economic, political, and market-based topics, and I continue to make media appearances 5 to 10 times per month. I don't really like reading my own bio. So Nadex is recording this as they record all of our webinars that we give you guys, and they archive them. If you want to read this in more detail, you'll be able to find it in that recording sometime tomorrow. So in prior classes, we covered the concept of moneyness and classifying a spread as either in the money, at the money, or out of the money. ITM, ATM, or OTM. That's what those acronyms mean. In the money, at the money, or out of the money. We taught the concept of spread premium and looked at how to determine both intrinsic value and extrinsic value. And we taught the Greeks what they are and how they apply to Nadex spreads. If you need to learn these concepts, which we think you do, please watch the recordings of our prior Nadex spread classes after this webinar, which can be found here, nadex.com/trading-academy/webinars. You look under webinars and then you go down to archived webinars, and that'll take you to where all of our prior ones are archived. If you haven't listened, if this is your first time joining us, make sure you go back. This one will be archived as well, but make sure you go back and learn all those prior concepts, because the way that we teach, each webinar is foundational for the next webinar, so they always apply. After learning the Greeks, most traders wonder how they can effectively translate that knowledge and information into useful and actionable trading information, and that's what we're going to do when we look to trade Nadex spreads at the null point. However, first we're going to do a brief review to ensure everyone is on the same page before we go into today's subject. So in a prior class, we taught at-the-money spreads. In a prior class, we reviewed the situation where a trader should consider trading a Nadex spread at the money. Again, please watch that class if you have not seen it yet. It will complement this class and help you become a more complete spread trader. In this class, we're going to investigate trading a Nadex spread at the null point. You're going to want to understand both of these, okay, at the money and the null point, because the most opportune time, the situations are different for when you want to trade at the null point and when you want to trade at the money. So make sure you learn both of these, because if you're going to trade spreads, which we think you guys obviously should, you're going to want to know both things. So let's talk about the null point. We refer to a Nadex spread being at the null point when the price of the underlying is trading in between the floor and the ceiling for both a long and a short spread. Remember, at the money was different. It was at the money in different spots, either the floor or the ceiling, depending on whether you were looking to be long or short. But the null point is the center, regardless of whether you're going long or short. This is the price where the spread is trading in the money with only intrinsic value. There is no extrinsic value at the null point. So here's an example. The null point, if you were looking to go long a spread. Here is the US 500, and the market is currently trading in between the floor price of this particular spread, which is 1900, and the ceiling price, which is 1940. We consider this to be trading at the null point. So if the S&P 500 and then subsequently the indicative index, the US 500, is trading dead in the middle of these, so 1920, the spread is now at the null point. It's the exact same thing on a short spread if you're looking to go short a spread. Okay? If the US 500 is trading in between the floor price of 1900 and the ceiling price of 1940, then we consider the spread trading at the null point. Here again, you have the US 500, 1900 to 1940 with a 415 expiration. Here we've got the S&P 500 trading at 1920, which will translate, give or take a few points, into the US 500 trading at 1920. If you don't know how the indicative index is calculated, go to Nadex's website. It's explained very good in a couple of videos there. If the S&P 500 is currently trading at 1920, then this is considered to be trading at the null point. So what is Nadex spread premium made of? Well, Nadex spread premium is made up intrinsic value, okay, the value between the price and the value at expiration, and extrinsic value, which is the time value. Those two components make up the Nadex spread premium. At the null point, there is no extrinsic value. There is no time value because it's dead in the middle. Now let me briefly go over the Greeks again before I turn it over to Mike. We can apply these Greeks to Nadex spreads, and the definition of each Greek is as follows. Delta is the sensitivity of the spread price to changes of the underlying. Okay, so the price that the spread, the premium of the spread, delta measures the sensitivity of that price to changes of the underlying. Gamma measures the sensitivity of the delta to the price change of the underlying. So gamma applies directly to where the delta is. Theta is the sensitivity of the spread price to the passage of time. You'll often hear theta mentioned as time decay. Okay, theta measures time in the spread. Vega is the sensitivity of the spread price to changes in the implied volatility of the underlying. And rho is the sensitivity of the spread price to changes in the interest rate. We are not going to talk about rho since we are trading spreads on a short-term basis, and rho will not affect the price of the spread the majority of the time. So you're not going to hear about rho. We have it in there for point of completeness. So now let's look at the extrinsic value components. Okay, since the null point consists of, is where the spread is, and the price, the premium, now has no intrinsic value of it. So what makes up extrinsic value, or the time value? It's the time until the spread expires, which is the theta, and the volatility of the underlying, which is the vega. Now, in typical longer dated option, it also includes the potential change in interest rates, the rho. But in the Nadex spreads, it does not, because again, they're short term. It's very rare that interest rates will change from the time that you put on a Nadex spread to the time when it expires, so don't worry about rho. So this contains both the traditional components that make up extrinsic value, and then in the red here circled, you can see the extrinsic value components for Nadex spreads. I'm going to go ahead and turn it over to Mike now, and then I'll be back to talk to you guys in a little bit.
Great, thank you, Bob. Great introduction. Hi, everybody. Hope everybody's doing fantastic. So let's really dive into the meat of this week's presentation. All right, in this session, we're going to examine in depth how time, as Bob just went over, theta, volatility, vega, market direction, and momentum affect Nadex spreads when trading them at the null point. This session will only focus on trading the Nadex spreads as a null point. Other path trading partner sessions focus on trading them at other locations. We did a different location, which was ATM last week. We'll do another location next week. We'll also mainly be focused on trading the spreads from the long side for the point of simplicity, although all the information we present directly applies to trading the same null point spreads from the short side. All the graphs I'll be showing are if you were trading the spread long. So you just flip them around for doing it short. It applies equally. Many traders look to trade the spreads when they are at the null point. Oh, hold on one second. All right, that first statement is wrong. Many traders look to trade the spread, at the null point. Really, if they're trading them there, it's because it's sort of in the middle of the spread and their reward to risk is 50-50. I'll have to correct that point. Oh, is this the right one? Hold on one second, guys. Hold on. One second, guys. I'm just looking at something to make sure we don't have the wrong thing up here. All right, there's just a typo in this one. One second. Sorry about this, guys. All right, just ignore the first two statements. I'll correct them later. And again, just as always, just trading a spread because it looks like you can make a lot of money without a lot of risk, or just because your risk and reward on anything is just 50-50 is not a good strategy. You have to understand what market conditions apply to everything. So once you understand the market conditions that can be beneficial to putting on a Nadex spread when it's trading at or near the null point, you'll be one step closer to becoming a complete spread trader. Let's look at real quick. Yeah. Hold on, guys. I'm still here. I'm just.
Bear with us 1 second, guys. I think I opened up the wrong PowerPoint, so I just want to find the right one here and get this right in front of you. I'd rather we took a pause here and got the right information than telling you guys not to pay attention to something's on the screen. So hold on 1 second with us. Bear with us 1 second. You know what's great is that the same technology that allows us to talk to you guys like this, sometimes we're stuck a little screwed up, but hold on 1 second, guys. So rather than have you sit in silence while Mike finds what he needs, I'm going to chat with you guys about something that that I wrote recently. I don't want to talk too much about it, but you guys will be able to read the whole thing. But we were talking a couple days ago. By the way, we talk about this kind of stuff on our podcast. I'm going to take this time to do a little shameless plug for the Money Path podcast. But I think one of the things that people have trouble with, and we'll get back to the main subject that we were supposed to be talking about in a second, is understanding that the difference between being a professional trader and then just trying to make excess money. And I think when you go into trading, you have to think of it, you have to pick one of those. Okay, you have to choose. And this is why we've taken such pains to go through the spreads. I think this is what? This, I think, is our 10th spread webinar maybe. And one of the hallmarks of Nadex is that their products are simple. And that remains true. Even though we're on our 10th or 11th spread webinar for you guys, it does remain true that these are easy to understand products. But that doesn't make them easy to trade. Okay, you think of like an automobile, and automobiles got much more simple as time went on. First you had to learn how to drive a stick shift, then you had to drive without power steering and so on, and cars got easier and easier to drive. But there still was a learning curve, and they were still dangerous if you didn't understand how to control the vehicle itself. Nadex does a couple of things that we're really proud of and really happy to be associated with. And number one is they structure products for you so that you don't have to structure them. All right, and that's really what we're talking about with the spreads. Okay, it's the structure of the product. The structure of the product is that of a vertical debit call spread, which is something that you could employ in regular options, but you would be forced to only do it on the day of expiration in order to mimic the product you have here. And also, you would have to construct them. So you would have to construct the actual spreads, as opposed to just going on and seeing where the underlying is, whether it's in the money, out of the money, at the null point when it's in the money, and just learning a couple of different things and situations where the null point is better, or in our last webinar, where trading them at the money is better, what you're supposed to be expecting, what you're supposed to be looking for to get into those. Nadex takes an entire sector toolkit process out for you, and that's the construction of these spreads. It's the same thing in the binaries, where binaries are essentially a reduced risk and targeted trade, which is something that most traders don't realize that they need to have. They need to have control of their risk, and they need to trade with targets, at least in the very beginning. But even for more advanced traders, having targets and having a structure like that is advantageous for a portion of the trades. So a lot of the time, what we want to go through, what we want to talk about, other than just giving you guys these lessons that we give you, is explaining why we go into such detail. And there's a couple of things I've seen out there that have bugged both Mike and myself, just in general, on trading education. And I think you have to vet people in terms of what their background really is when you start to get involved. And the reason I say that is because everybody out there, I think everybody that works with Nadex has your best interest in mind. I really believe that. Mike and I, on the other hand, we cater a little bit more to somebody who wants to take an augment of income and then potentially even turn it into something more permanent. Every single person that's listening to me right now has the ability, in one way or another, to trade successfully. And I always like to say in one way or another, because some of you may be sitting there having just watched The Wolf of Wall Street and say, wow, this is really what I want to do. I want to be this guy. Well, you're most likely not going to be. Okay? Very few people have the ability to legally get the sort of financial success that you've seen in movies. Okay, The Big Short, for example, which, by the way, there's a lot of lessons to be learned in that movie if you haven't seen it. But every single person that we talk to has the ability to trade successfully on some level. So you have to go into it thinking, okay, what is it that I want to do? What is it that I want to achieve? Do I want to achieve an augment of income? Do I want to make enough money for a vacation every now and then? Do I want to, what is it that my target is for these things? And understand the realities of what trading is. And that trading itself is not something that just happens overnight. Okay, it's something more along the lines of study, research, practice, and get to the point that your particular skill set allows you to. So I've got this beginning slide up here again, because I think we've got the right information up here now. And Mike, if you could just tell me what slide you want me to get to, and I'll turn it back over to you.
Just get it back to where you turned it over to me the first time, this session. I'll just start it from there.
There we go.
Just like if you put on an incorrect trade, it's best to cut it, get out. You know, you don't hang on and hope it's going to fix itself.
That is a fantastic analogy. Michael, you should still have the mouse. Let me just make sure you still have it.
Yeah, that is a good lesson. If you put on if you make a mistake when you're trading, you know, you put on the wrong binary, the wrong spread, or let's say you put it on the wrong direction, the best thing to do, this is stuff we've taught for years, is just get out. Get out, reassess. You know what? Don't start hoping, oh, well, I went short when I went to it gone. Oh, now the market's going down. Let me just hope this trade works out. No, cut it. Even if you have to, you know, you pay the spread, oh, I'd have to go to the other side, you lock in a quick loss, that's fine. Clear your head, get back, and then you make the correct trade. You don't try to make a bad situation better by just letting it go on. So that's sort of what we had to do here, tying it into a trading aspect, as we seem to do a lot. So I will start over. Thank you, Bob, for the great introduction this week. This session, all right, this session, we're going to examine in depth how the time, theta, volatility, Vega, market direction, and momentum affect Nadex spreads when trading them at the null point. This session will only focus on trading the Nadex spreads at the null point. Other PTP sessions, path trading partner sessions, focus on trading them at other locations. Just as we did last week, we're at the money. Next week, we're going to do in the money at a place I call the Theta capture point. So you'll want to tune in for that one also. We'll also mainly focus on trading the spreads from the long side for the point of simplicity, although the information we present directly applies to trading the same null point spreads to the short side. You're just going to have to flip it upside down, essentially. Many traders look to trade the spreads when they are at the null point because they look at the reward to risk and they see they can get close to 1-to-1. You know, last week we talked about the at the money. Oh, I can get this little risk for huge Huge reward, okay. And we talked about, well, you really got to look at certain market conditions because, you know, if you're taking very little risk, but you're losing 95% of your trades or not making money on 90, it's not really that good an outcome. Now, another key location people look at is, because it's really drilled in their heads, and it's a good thing to have it drilled in their heads. I don't want to go worse than 1-to-1 reward to risk, or I want to be right around 1-to-1 reward to risk. That's a great thing to understand as a trader, okay? But just because it's at that 1-to-1 or in that vicinity of 1-to-1 reward to risk does not necessarily mean you should, again, put the trade on at that location. There's a lot of things that go into putting a trade on at a specific location. The trader needs to understand market conditions that are best suited to initiate these kind of trades. So we're going to be going over really 3 different locations, one last week, one this week, and one next week. And understanding these 3 major locations will help you. Just trading a spread because it looks like your reward to risk is close to 1-to-1 does not necessarily make it a good trade. Once you understand the market conditions that can be beneficial to putting on a Nadex spread when it is trading at or near the null point, you'll be one step closer to becoming a complete spread trader. As Bob already went over, but I'm going to reiterate, the null point is right in the middle or roughly in the middle, and you can have slight variations depending on skews or anything else, but mathematically it's in the middle. Why do we call it the null point? Because it has virtually no or no extrinsic value. Even though it is in the money, and pretty much here, down here's at the money, at the floor price for a long trade. So as soon as it gets above at the money, it has intrinsic and extrinsic value the whole way up. The interesting thing about the null point, the extrinsic value is essentially 0. So you're, for example, at 2005, if we're putting on this US 500 2010 spread, intrinsically it's worth $5. We're going to pay, the bid and offer are going to be roughly on either side of that $5 range when it's right in the middle. I'm not paying any time value or volatility value on top of there. Down here I am. It's intrinsic plus extrinsic. Up here it's still intrinsic plus extrinsic, but the extrinsic happens to be negative. That's how you can capture theta up here. And down here, theta eats away at your position. Here, there is no real, and we'll get into this, there's no real time decay because as long as it sits there, you're not really paying for extrinsic value. That's why we call it the null point. So as I just covered, when we're exactly at the null point, there's no extrinsic value. The value is intrinsic value. If you're trading a spread slightly below the null point price for a long trade, there's very little extrinsic value. The majority of the value is intrinsic. If you're trading it slightly above the null point price for a long trade, the majority of the value is intrinsic and the extrinsic value is negative. Just jump back to this. So if we're trading it right down here, when I talk about slightly below, if we're doing it right here, we're going to have mostly intrinsic. For example, let's say 2004, roughly it'd be trading about 4.5 at this time to expiration. Okay, so with 120 minutes expiration at this specific volatility, but $4 of that is intrinsic, so the extrinsic value is only 1/2. If we're trading it, let's say at 2006, we come up here, all right, about, let's just come up right here, 2006, it should have intrinsically $6. It's trading for slightly less than that, $5.50, because the extrinsic value is negative. So it does have, whether the extrinsic value is negative or positive, it does have it slightly above and slightly below. That's what I mean by those points. Since either all the value or the majority of the value is intrinsic value, time does not have a large effect on the value of the spread. I think you can already, if you followed our webinars in the past, or starting to grasp the concepts of theta and the Greeks, you might already be able to see how that can be a value at certain conditions or certain market conditions. So if price action is stagnant and not moving further into the money, then unlike at-the-money trades, the passage of time does not affect the null point spread trader's position. Remember from last week, and if you haven't seen this one, please go back and view it. At the money, you are going to have that time decay that's going to get more and more and more. It's going to hurt your position if the underlying price is not moving and it's still sitting at the money, that time decay is going to eat away at your extrinsic value. Well, null point, there's not really anything to eat away at. So if the price action or the underlying is stagnant or congesting, or just trading in a tight range, you're not going to have to worry about time decay hurting your position. Other things can, affect your position, like if underlying moves against your position, you're still going to have the effect. A stagnant market condition isn't going to hurt it. This is true no matter how much time is remaining until the spread expires. Remember, theta gets more and more severe, either in your benefit or to your detriment, the closer it gets to expiration. So at the money, theta gets more and more severe to your detriment. Next week, we can show how it gets more and more beneficial to you. Spread value and theta. Remember, theta is a time decay of the spread. Theta, remember time. Theta can help or hurt the spread trader depending on where the spread was entered, but as long as the underlying price remains at or very close to the null point, theta does not affect the price of the spread. If the trader is long the spread at the null point and the underlying trades back down towards the floor price or closer to at the money, then the time decay is working against the trader and eroding the extrinsic value. To understand that more, go back to last week's presentation. However, if the trader is long at the null point and the underlying price moves closer to the ceiling price, then the time decay is working in the trader's favor, and we will go into that more next week. As the spread approaches expiration, the time decay effect is more pronounced at both the floor and the ceiling prices. I'm going to keep stressing this because it's very important. It's one of the aspects that, theta is not linear. It actually accelerates the closer you get to expiration, which can both help and hurt you. It's one of the key points I really want spread traders to get, because you can use it to your advantage once you really understand it. Price versus time. Right now we're talking about the null point. So if the underlying is sitting, the E-mini S&P 500, we're looking at the US 500, which is based off the E-mini S&P 500 futures contract. If we put it on at this 2005 and it sits here until expiration, you see how no matter what the time is, we have a whole bunch of different times here, the value doesn't really change because it's intrinsic value. If we put it on at 2005 and we can get the actual 2005, don't worry about the bid offer right now. Let's just say we're putting it on at theoretical value and it sits there for 120 minutes. Theoretically, it's still worth the $5 that we put it on at. If it were to go down, as we covered last week, we put it on closer to at the money, the time decay eats away. If we put it on right at the money, intrinsically it's worth 0. Extrinsically it's worth, like up here around just over 2 with 120 minutes. It slowly erodes to 0. If we put it on up here, it goes towards full value because the extrinsic value is negative and theta works on our behalf. But right here, it doesn't affect us. Here's the graph of theta, and this is with a certain implied volatility. You can't separate all these components, so this is a certain implied volatility, and this is with 15 minutes to go. We're right here, the middle, 2005. You can see theta is 0. It doesn't affect your spread. At the money down here, you can see it's negative. So every moment that passes, this eats away at your position if you're along the spread. Up here, closer to the ceiling, theta is positive. This helps you. Null point, theta is 0. Theta versus time, you can see it again here. Here's all your different times. Theta doesn't change. It's 0, no matter what. At the money, you can see as it gets closer and closer to expiration, it starts spiking all the way down to hurt you more and more. Up here towards the ceiling price, if you're long, it starts spiking more and more positive to help you more and more if the underlying is staying at that price. All right, so let's get into some market conditions. And how path trading looks at these market conditions. So trading a spread at the null point is one of the most lenient places a trader can enter into a spread trade. Since all or nearly all of the value is intrinsic, there's little or no time decay. This also applies to Vega when trading the spread at the null point. For the people who've seen our webinars in the past where we go over the groups, remember, in most of these graphs, Theta and Vega, time and volatility, are interchangeable. The graphs look the same for most cases. Increases or decreases in volatility do not affect the spread at the null point since it is intrinsic value only. Implied volatility, which is a component into the option pricing model, just like time is a component of that, affects the extrinsic value. Since we don't have extrinsic value, changes in implied volatility also do not affect the spread at the null point. However, keep in mind that as the spread moves away from the null point, Theta and Vega do come into play. Since Theta or Vega do not come into play at the null point, what market conditions should a null point spread trader consider? Well, the null point is one of the most flexible locations to put the trade on. Time to expiration can be long or short. All right, it doesn't matter. You find a spread, you have to have some market opinion because you don't just want it sitting there, but it doesn't matter if it's 15 minutes until the spread expires, 2 hours till the spread expires, 8 hours till the spread expires. The time decay isn't going to hurt you or help you, so therefore you could be flexible on the time to expiration. Volatility can be high or low. It can be done in high volatility conditions, implied volatility conditions. It can be done in low implied volatility conditions. However, we do require some kind of trend be present. Why is that? Because let's say we're putting it on at the long null point spread position, the market should be trending upwards. Again, if it just sits there, it's not going to do you any good. As I went through a few slides ago, if it sits at the null point, the underlying does not move away from that point, no, you're not going to lose money, but you're not going to make money. All right? So for a long null point spread position, if I'm looking to put it on at the null point position, I want the market to be trending upwards. For a short null point spread position, I want the market to be trending downwards. I don't want it to just remain there, and of course I don't want it to move against me because that's not beneficial to my position. The strength of the trend is important for selecting the expiration of the spread. The strength of the trend is also important for selecting the ceiling price for a long spread trade or the floor price for a short spread trade. All right? In slower trending market conditions, a ceiling or floor price that is closer to the null point should be chosen. Why? Because I want it to be able to reach that ceiling or floor price for my spread to reach its full value. So if the market's trending slowly or in slower conditions, for a long trade, I want a ceiling price that's closer. I don't want to just say, look, I can choose a ceiling price that's really far away, but if the spread's going to expire before it gets even remotely close to that ceiling price, it's not the best choice. I want to trade something that fits within the volatility parameters. In a slower trending market, I'm going to choose something that's closer. I want it to trend towards that ceiling price. For a short, I want it to trend towards that floor price. So slower conditions, I'm going to choose a floor price that's closer to the null point. So in a strongly trending market, a spread can be chosen with a ceiling or floor price that is farther away. Now, the strength of the trend also affects the expiration time, the spread expiration time that the trader should choose. For example, for a long null point spread trader in a strongly trending market, a shorter timed expiration spread should be considered. Why? Because as it moves away from that null point and towards that ceiling price, and I'll go back into these graphs, but we're now in the money, approaching the ceiling price, that we want to then capture that theta. We want that time decay to work for us. Again, we'll get into this next week. The faster it can get to that ceiling price, okay, The more we can capture that theta, the more the spread will get to full value for us sooner. So we can even possibly take it off. And if it keeps going through that ceiling price, it will, again, mature to full value faster. We won't even have to rely on all that theta capture to get it there. And we can take it off even before the spread's going to expire. We don't even have to wait to expiration. So that's something to consider. Conversely, in slowly trending market conditions, a longer timed expiration should be chosen by the trader. If it's moving slowly, I have more time for that time decay to kick in. I have more time that the trade can get there. I can let it work on my behalf as long as the trend maintains. All right, let's look at the spreads and Vega. Again, Vega is the implied volatility component. So we've already considered that Vega does not affect the spread at the null point. However, in high implied volatility conditions, when the extrinsic value is at a premium, the trader should consider trading the spread at the null point. This is because the trader will not be paying for the extrinsic value when entering at the null point. I love to put these on in very high implied volatility conditions. Here's what the graph of the Vega looks like. We're at the null point right in the middle. You see it's 0. Down here, this would be at the money. Up here would be close to the ceiling price for a long trade. This, again, is a 1% based off a 1% increase in implied volatility. So if we were down here, as we covered last week, at the money price, every 1% increase increases the price of the spread. The Vega is increasing the price of the spread. Why? Because we have a lot of extrinsic value. If we're up here by the ceiling price, a 1% increase in implied volatility actually decreases the spread. It actually makes the extrinsic value more negative. But right at this null point, it is 0. So this is easier to see on this graph. Null point, no matter, here's a wide range of volatility conditions, implied volatility conditions, ranging from 10 to 35%. You can see it does not change the value of our spread. It's intrinsic only. Down here at the money, you can see if implied volatility goes from 10% to 35% without the underlying moving, the spread price is going to increase dramatically. If you see up here at the ceiling price, if we're sitting here and the underlying is not moving, we go from 10% to 35%, the spread price is actually going to decrease dramatically. That's, on this previous slide, that's what this is showing here. Sometimes people get confused on this. Implied volatility is going up, Vega is negative, it's reducing it's making the extrinsic value more and more negative. That is what is reducing the spread price. Now, one interesting thing, like if we're down here and we have a huge implied volatility at the money, we're paying right at 2,000. We're not paying for any intrinsic value if we're trading it right here. It's all extrinsic. So this costs us roughly, at 35% volatility, $3.50. That's all time value. So this thing's got to move up. Our underlying has to move up at least $3.50 before we've even made that money back. However, if we look to put on one of these spreads at 35% volatility right here at the null point, we're not paying any of that. So if this moves up that same $3.50, we're now $3.50. It's moved up. We don't capture the whole thing because of the delta concept, which I'll get in, but we've captured some percentage of it. That's why it's important. I've seen incredibly high, especially on major sell-offs. If you trade the financial indices, if we have major down moves, the implied volatility of these spreads can get huge. And when you see them get very, very large, it's unreasonable. I've seen them get so big that it would just make no sense to put them on down here. Okay? Because the implied volatility, therefore the extrinsic value is so high. So where am I looking to trade these? If the market's trending and I don't want to pay up all of this extrinsic value, I pinpoint this null point for long and short trades. Okay? Vega versus time. for a point of completeness. Now at the null point, you can see it's 0. Time doesn't matter. It's still 0. If we're long and it goes further in the money, the effects of volatility go down as it approaches expiration. And if we go down for a long trade and we're at the money, the effects of volatility also go down as it approaches expiration. That's a key thing to remember also with trading these spreads. Volatility has less and less impact the closer it gets to expiration. Changes in the applied volatility of the spread has less and less impact, because with less time, there's fewer outcomes possible that the underlying could really go to. So even if it's higher volatility conditions, time reduces the effect as you get close to expiration. Here at the null point, you can see no matter what, it's not going to change from 0. But if you're trading at the null point, you want the spread to be moving. You know, if you're long, you want to be moving towards the ceiling. If you're short, you want to be moving for the floor. That's why you also have to understand these other points, because these other points are going to come into play as your spread moves. Let's look at the delta revisited. So it's important that a trader understands the delta of trading the spread should be at the null point. The delta is the amount the spread price will move in relationship to a 1-point move of the underlying. So if the delta is 0.5, then the spread price will increase or decrease half as much as the price of the underlying. Remember, delta. So if you see a delta of 0.5, it's going to move half as much, either up or down. If you have a delta of 0.8, it's going to move 80% of the spread price up or down. If you have a delta of 0.2, it's going to move 20% of the spread price up or down. When trading a spread at the null point, the delta is always highest it will be for the spread at any given time. As the time to expiration becomes closer, the delta will rise and approach the value of 1. So when a trader is trading a spread at the null point, the spread will change at a greater amount both up and down than any other point on the spread, up or down. So if we're long, we get the benefit if it's going in our direction. We also get the detriment if it starts going against us. Key point to remember. Here's a graph of that at the money 2005, showing different times. The bottom area is 120 minutes. You see, given this implied volatility, you know, our delta is looking at about 0.6, so it's going to move 60% of the spread price. Now as it moves, let's say we're long, as it moves up and up and up, you see the delta goes down, 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 so we don't get as much bang for our buck as it gets closer and closer to the ceiling for a long. Also, if it's moving against us, it stops moving as quickly as it goes towards the floor price. Back to the null point price, if we're sitting here and let's say the price underlying isn't moving and time's working against us, well, if it does start moving in our direction, okay, long, let's say we're long, as it gets closer to expiration, we're getting closer and closer to it moving 1 for 1 at the spread price. For example, at 30 minutes to go, it's more, with this implied volatility, it's more at about 0.9, whereas with 120 minutes ago, it was at 0.6. So if you put these on closer to expiration, you can get more. The delta gives you more and more, so it's going to move closer to 1-to-1 with the price of the underlying. However, if it goes against you, that's also true. Keep that in mind. So maybe if you're putting these things on closer to expiration, you don't want to take a lot of risk should, let's say you expect it to go up. You're putting on a long spread price, and you only have 15 minutes expiration with this implied volatility. Well, you're getting a pretty decent amount of delta. So it's moving towards the ceiling, great. Your spread's gaining in value quickly. However, if it starts moving against you below that null point price where you put it on, it's going to be moving against you quickly. You need to consider that with your stop loss, with where you're getting out. These are all things you have to work into your strategy. The same things that can be benefits can also hurt you. More considerations for null point spreads. Since we're trading a null point spread either at or very close to a 1-to-1 reward to risk ratio, we should plan on having a stop out level and not taking on the full risk of the spread. In other words, let's say we enter a $100 spread at a price of $50. We therefore have a risk of $50. We should have a price level based off the price movement of the underlying where our assumptions are incorrect and plan on exiting the spread at that point. Let me go back to the graph. Because, you know, if this thing goes up, keeps going down, it's not working towards our benefit. The delta starts working against us if we're long this. Find another graph in here. Let's just do, we can just use it here. Just ignore the volatility component. Just take it at a specific price. So if we're trading it here, we put it on and we expect this thing to go up. But it starts going down here. The underlying starts going down. We don't want to just hang on to this thing and say, oh, you know, there's got to be a point where, especially if we get towards the floor price, time, everything starts working against us down there. So we don't want to just sit there and say, oh, I hope it comes back because now the theta is working against us. It's decaying. You know, it's gone against us. We don't just want to hold this and take the full loss of this. We want to level based off where the underlying is trading to say, okay, you know, I thought it was going up, or at least stayed close to there, but now it's starting to trend against me. I want to cut my position. I don't want this to go to ceiling price and just sit there or keep trending against me. That just turns into a losing proposition. Reverse on the short. So you just don't want to hold and hope if you're trading it at the null point. You have to understand where your trade could be wrong and where you're going to get out. All right. To continue our $50 entry example, let's say we entered a long null point spread because price was trending up and implied volatility was very high. So we're saying, you know what, implied volatility is really high. I'm going to use this at the null point. I don't want to pay all that extrinsic value, and it's trending in my direction. I want to put on a long spread. However, a short time after entering the long spread, the price of the underlying sharply reversed and broke the critical price action support, thereby nullifying our reason to be in a long spread position. Instead of taking the full risk of the trade, based off the underlying trading below the floor price on expiration, we should exit the spread when the critical support was broken, taking a quick loss and not risking the full $50. Let's take a look at some non-optimal conditions. I sort of went over some optimal conditions. You know, you want it trending. You don't want it to be, it can sit at the null point for a while. You know, like maybe I'm putting this on in slower market conditions, but, you know, I expect the trend to pick up. I expect it to strengthen. That's fine. Okay? But let's look at some things, reasons I wouldn't want to put this thing on. We're not looking to trade null point spreads when the price movement is stagnant and not expected to move. As I said, it's okay if it's stagnant for a while because you're not really paying for extrinsic value. However, you want it to pick up at some point. You just don't want it to sit there the whole time. So you have to have some expectations that market conditions are going to change, or if it's gone stagnant, that they're going to pick up again and start trending in the direction of your trade. We're not looking to enter null point spreads if the market is expected to move or trend against our position. Rather obvious, but you know, we're putting it wrong right in the middle of that spread. So if we expect it to have the potential to move against us a fair amount and go towards, for a long price towards, to go towards that floor price where now our theta is working against us, that's not a really good strategy to use for this kind of initiating a spread. So keep that in mind. If you're unsure, you know, there's other ways you can make trades if you're unsure about conditions or you think it could just move one way or the other. So if you think, oh, this could go, it's either going to go really sharply for me or against me, all right, well, if it starts going to move really sharply against you, you have to get out quickly. We can enter null point spreads during slow market conditions as they are expected to pick up well before expiration, but we should not enter soon to expire spreads at the null point during very slow non-trending conditions. Why? If it's close to expiration and it's not really trending, there's no benefit because it's just going to sit there. So now you're taking on risk because you're putting it on in the middle of the spread price. So you're taking on potential risk. And you're not looking for, if it's not going to move, you're not going to really get the reward. And when you take on potential risk, anything can happen in the markets. So even though it's stagnant now, if price starts going against me rather quickly, you know, that's not a good thing to do. So I better have expectations. This thing's going to move, and it's going to move in my direction. Like breaking out of, let's say I'm in this long and it's breaking above a critical resistance level. that could be good conditions, especially going into busy conditions, busy market conditions. That could be really good conditions for putting on these null point spreads. I lost there we go. Examples of non-optimal conditions. Let's look at some more of them. So, early evening trades in currencies, and usually in equity indices and commodities, when price is tightly range-bound and not expected to break out. There's no real benefit for me putting it on here. I'm not going to capture time decay. I'm not, I wouldn't also consider putting them on at the money in those places either, because time decay is working against me. But at the null point, I'm not expecting the price to really move, so there's nothing, I'm taking on risk, and I'm not getting any expected reward, because unless it moves, I won't get any expected reward. Not good times to put them on. A short time before a major report release. For example, putting on a null point spread at 1:45 p.m. that expires at 2 p.m. when there's a major Fed announcement that is expected at 2 p.m. and price action has gone dormant. Why? Because the underlying might just sit there. So now, again, I'm taking on risk. I'm not expecting this thing to move till after 2 when they release the report. It's 1:45 now, so by the time this thing moves, my spreads expire. I've taken on risk without any potential real upside and reward.
Hey, Mike, I'm going to read this question that came through real quick, because I don't know if you can see it, and I'm going to give a brief answer, but stay on for a second, because I think you're going to want to add to it. Ephraim says, one cannot trade at the very bottom of a move to go long or at the very top of a move to go short and try and get the maximum profit potential. Please explain why the null point is of interest, because with the use of technicals, one can trade below the null point on a long or above the null point for a short. Am I missing something here? Ephraim, the entire idea of trading below the null point or above or at the null point has to do with the components that make up the price you're paying. And that's why we talk about optimal conditions to pay at the null point. You can get a similar profit ratio if you're willing to exit a null point trade before the actual expiration. You can get a similar profit ratio, but the entire point of trading at the null point is the conditions that surround it. Same thing with trading at the money or even out of the money for that matter. You have to understand these are options. These are not simple technical underlying trades. There are two components that go in to the cost that you pay. And this entire presentation was about not paying extrinsic value, which is what you do at the null point. So if the conditions are right, a trade at the null point is relatively cheaper than below the null point or above it for a short. Go ahead, Mike.
And he's asking another question, well, what about the loss of intrinsic value? Well, your spread's going to move. It's why I said, if you're trading at the null point and the trade's going against you, you're going to want to have a level to change it. Pretty much like if you're trading at the money, if the price is going against you, let's say you're long at the money, it's going down. No, you're not losing any intrinsic value, but you're losing extrinsic value. You have to consider what the ratio is to intrinsic to extrinsic, what the implied volatility conditions are. For example, as I touched on earlier, trading at the money. Yes, you can always get a better reward to risk ratio if it were to go all the way to the ceiling price. But it's not always going to go to the ceiling price. And given certain market conditions, with your Theta and especially your Vega, your changes in volatility, or your Theta, how it's going to react as you get closer to expiration, all those things come into play when you're considering trading these spreads. As Bob said, they're options. They're built from options. So there's different locations that these things are going to be beneficial or detrimental to you.
Think about it, 35 moves. I'm sorry, Mike. Well, I'm just referring back to the 35% volatility example, which I think fits this question very well, where you may want to go long below the null point, but if volatility is at 35% and it only creeps up a little bit and then volatility falls, you're going to actually lose money even though it goes in your direction.
Why don't you switch back to one of those slides and we'll just take a quick look.
Yeah, you can still use the mouse, Mike. Go ahead.
Can you get back there quickly, though, to the slides?
Yeah, I can. Here, this was, to me, the best visual example.
So let's say I expect, let's say I want to go long at the money down here. Where, let's see, do I have the, there, at the money of this. And I expect volatility to, let's say it's high and I expect it to drop. Would that be a really good, even if this thing starts moving, let's say underline's creeping up slowly and implied volatility is coming way down. So it's moving, but look what's happening in my position because I put it on at the wrong place. I put it, or not optimal, I shouldn't say the wrong place, but not optimal conditions. So if I put it on up here at the money, and I'm at 35% implied volatility, and I paid 3.5. Now let's say the underline moves up even 2 points, but implied volatility drops all the way down to 10%, theoretically. Well, now, even though it went 2 points in my direction, the spread's only worth 2.5. What happened there? It went 2 points in my direction, but implied volatility dropped. So the spread actually lost value because I did not put it on. I did not consider the market conditions. I did not consider that it was an option spread and all the things that play into an option spread. I've seen this with just core options all the time. People put on a position and go, it went my way, but I didn't make money. Why? Because there's components in an option pricing model, like time decay and implied volatility, that if it doesn't move in the right amount of time, or if implied volatility changes in a way that doesn't help your position, putting on, you can get the direction of the underlying right, but putting it on in the wrong location or choosing the wrong option or just putting on the spread in the wrong location can actually be detrimental. And we've seen this countless times. Somebody goes, I put on this and it went, the underline still went up 2 points, but my spread's now worth less than when I put it on. Well, something changed. Either you had too much time decay kick in because it didn't move enough in a certain amount of time, or the implied volatility conditions changed. So the implied volatility went against your position. Does that make sense? That's what we're trying to show people by considering, all these different locations. There's times, when we'll get into this next week, when I'd want to put it on up here. Even though my reward to risk looks, hey, well, I'm trading it above the null point for a long, so I might be risking 70 to make 30, but there's certain conditions where that is a really good trade. Why? Because I'm not going to really risk the $70 to make the $30. I might be risking 20 to make the $30, but the market conditions are such that, look, let's say I put it on up here, and this is a preview for next week, guys, so you'll want to stay tuned, but let's say I'm putting it on up here and I expect the market conditions to be really stagnant, for the underlying not to move, and for implied volatility to come down. So underline's not moving and implied volatility is coming down. I'm making money just in implied volatility changes. You couple that with theta kicking in, that works on my behalf, I'm making money because implied volatility and theta is working for me. The underline's not moving. No, if I put those kind of conditions on down here, that's the worst kind of thing. Underlying's not moving. I'm at 35% volatility dropping, and it's not working, so time decay is working against me. I have everything working against me down here. Up here, I have everything working for me. Right here's in the middle. So there's understanding how all these pieces fit together to form the bigger puzzle is what we're trying to do here to make you a well-informed spread trader.
I don't know if you can see the responses, but Ephraim did say, thank you. I'm thinking as a trader, I need to think as you were trying to teach. Thanks for the explanation. I do now understand the null point. And when you said, does that make sense, he said yes. So that was good.
Right.
Because, again, in that example Mike was just talking about where it's above the null point, you can actually put it on at 35% volatility, have the market move slightly against you and make money. That could actually happen if volatility falls. So it's very confusing. Ephraim also said he's an E-mini trader. So it's very confusing for those of us, which including myself a few years back, where you just traded underlyings in the past, and you're used to thinking, okay, if I get the direction right, I'm right. Not the case in options. And that's what Nadex binaries are, and that's what Nadex spreads are. They are options.
And that's why we're giving you guys all this in-depth knowledge, bit by bit, week by week, and we're showing you these concepts. So we're not just teaching the deltas, the thetas, the vegas because it's cool math, because it
is cool math.
Because the more you grasp this thing over time, the more you'll be looking at the market one day saying, oh, with these conditions, I remember Bob and Mike talking about this. This would be a really good opportunity to put on a spread at this point because I'm starting to really grasp how these market conditions are conducive to putting it on at this point. Maybe I would have put it on because I didn't understand these concepts at a different point before. But now I really want to search out a spread that's trading maybe closer to the null point. Or these are really good conditions to put on when it's trading at the money or in the theta capture zone. You're going to look at these timed expirations. You're going to look at where the underlying is trading. You're going to look at the different spread options, and the light's going to go off, and you're just going to say, hey, I want to target this kind of position because I'm starting to understand how all these components work together. And I'll turn it back to you, Bob.
Thanks, Mikey. Thanks for that. So Ephraim and Phil said thank you for that as well. So Ephraim says lower volatility can be your enemy at a lower value than the null point as it can in any market. That's exactly what we're trying to teach, Ephraim. That's exactly what we're trying to get to. And Phil, thanks for your comment as well. You know, we have to make sure people understand because that's one of the things that happens, and it's one of the underrepresented points we feel, and it's why we wanted to do this in the first place, was to get to the point where we can show you guys, look, you might get the direction right. You might get even a couple of other points right, like how far it's going to go. But if you don't realize that these things are options and that there's other factors affecting what's going to happen to your position, you know, you won't understand why you made or lost money. So how do you determine IV before you trade? We'll talk about that in a second, Phil. It's more necessary that you recognize it than you determine the actual implied volatility. It's more important that you recognize what's happening. So, and we'll go into that in another class as well. But let's talk about an optimal example here because we're going to start losing everybody's attention in a minute. So this is an optimal example, something that we actually did. Shortly after the open of the CME E-mini S&P 500, Path Trading got a multi-time frame divergence signal to go short the S&P 500. As you mentioned, Ephraim, E-mini trader and technical trader, we also trade price action. So based on implied volatility conditions, there you go, Phil, just conditions. Based on implied volatility conditions and a Fibonacci retracement extension target, we decided to go short a Nadex spread at the null point. At the time of the signal, the price action was in congestion, so we opted for a longer expiration spread. The following charts review the trade that we did. So implied volatility was stable. Trade triggered at 9:40 a.m. with a valid close triggering the multi-time frame divergence, okay, which you can see over here. Here we were looking at a spread of the 1920 to the 1950. Price action stop level identified above 1938.5, okay, which you can see here. This is where we identified that we would get out if the price action got above there. We weren't going to hold it to expiration, okay? We had a single target of 1920.7 identified based on a Fibonacci retracement extension, which you can see in the target right here. And obviously, here's your divergence right there. You got higher highs, and you've got lower lows on the lower highs on the RSI. Okay. Due to a range-bound price action, we chose a spread that expired at 4:15, since we were not sure when price would break lower. So we wanted a longer extension. Longer expiration rather. The spread was sold at 1935.2 for a max profit of 152 and a max loss of 148. Even if that would have been flipped, we probably still would have done the spread. We're not bound by the max profit and max loss that you see at the bottom of the ticket here because we're not going to hold it to expiration. Okay, if it goes through our stop, we're going to go ahead and get out of it. Again, the target of 1920.70 was reached approximately 90 minutes later, so we closed out the spread. You can see the extension here off of the divergence and the reach of our target. Now, at this point, we don't care if it continues to go lower or not. We're going to go ahead and exit our spread. The spread was covered at 1924.6, resulting in a profit of $106. These were optimal conditions to put something on at the null point. And you can see the reaction at our target. Now, the reaction was a reversal back toward taking some of our profit away. But we don't care about that. One of the things that we teach and that we do constantly is when it's time to exit our trade, we exit our trade. We don't look for any more than we were looking for. We don't necessarily sit there and say, maybe it'll go, maybe we'll get extra money out of this. We planned our trade and we stuck to it, so we exited at our target. Even though we got this little extra 2-point blip down here, you can see the reaction and you can see the close and then the reopen right at our level tells us that we did the right thing. So this is an example of why we exit once our target is reached. Let's take a look at another optimal example. With 152 minutes left in the trading day of the S&P 500, we received a trade signal based on a close beyond a path trading trend line. It's a particular type of trend line that we draw with its own rules. Earlier in the day, implied volatility was rising with the market sell-off, but implied volatility had begun to drop a bit, but was still relatively high. So we chose to target a long Nadex spread trading at the null point. So here you have that chart. Here's the path trading trend line. Again, there's some specific rules for drawing these trend lines, and we got to close above that particular trend line. So we chose an 8 a.m. to 4:15 p.m. 1900 to 1930 spread with approximately hour and 52 minutes to expiration. The underlying was trading at about 1914.50. We were able to get the spread on at 1914.70 for a total risk of 147 and a potential reward of 153. Again, even if these were flipped a little bit, closer to 1-to-1 or even slightly negative, we would have still considered this particular spread because it was the closest to the null point, which is what we were looking to trade, and we're not going to hold it to expiration anyway. When our price action, if our price action proves the trade to be going to a loss, we would have covered it. Our target based on a past significant level was 1928.8, which lined up nicely with the spread ceiling of 1930. But you can see on the chart right here, it also lined up with this bit of congestion right here, which a lot of just pure price action charting people would have looked at. Our stop level was at 1901.90, which was right here. It's the base of this moving average, and some other significant levels off to the left that we can talk about another time. Our target was reached at 340, so we immediately closed out our spread at 1927.2, and this led to a profit of 125. Remember, the max profit was going to be, if we go back, 153. Right? But because our target was reached, we took our $125. All right? That's what we do when it reaches our target. A target isn't necessarily a place where you have to exit, but a target is a place where an action is necessary. And for us, with these particular short-dated expiration debit call spreads that the Nadex spreads are, it calls for us to exit the particular trade. So that's what we did here. Again, the null point spread was the right choice in this particular one because of what was happening with volatility. So in this webinar, we covered various aspects of trading null point spreads. We examined how some of the Greeks affect the spreads, and we also looked at the optimal and non-optimal market conditions, which can help a trader determine when to trade the spread at the null point. You will probably need to review this information multiple times and then determine how this information can work to further help you successfully trade null point Nadex spreads with your trading strategy. Remember, that's not going to be every time you trade a spread. After watching this particular webinar, this particular lesson, you're not going to want to run out tomorrow and go, okay, I only want null point spreads. There's different times where we want to affect trades in different places. And Ephraim, if you haven't, or I'm sorry, I'm speaking to all of you really, but we were talking specifically about this to Ephraim. Please go back and watch the At the Money Trade webinar as well on the Nadex website. It'll give you more. You can find it on the Pat Trading Partners website as well, but they're all archived nicely in the webinar section at Nadex. So go back and watch that, and you'll see the times that it's optimal to trade exactly what your question implied. Next time, we're going to look at trading in-the-money Nadex spreads with theta capture. So we're going to capture some time decay. We will again look at the market conditions that are beneficial and detrimental to trading spreads in the money in order to capture the time decay. It will be helpful for a trader to again review the Greeks and the various characteristics of them and how they apply to Nadex spreads. As always, please go to @path_trading and then like us on Facebook. I want you guys to do both. All right, I spoke ad-lib there for a while, so can you just go ahead and do that for me, please? And please go to our website to sign up for our free webinars. And more than anything, I'd like you guys to sign up for our podcast, The Money Path, which we actually talk about a lot of things. We talk about some Nadex stuff, we talk about currencies, we talk about stocks, and we talk about commodities. And then please read our blog articles, which can also be found at the Path Trading Partners website. Any questions other than the ones we already addressed? Ephraim says, I get it. It's a concept that many traders don't get. If I put a trade on at low volatility, it will most of the time fail, but fall back into my buy price and I will get stopped out. Yeah, that could happen if your buy price is based on the spread price, sure. Right? I mean, the spread price will fall as volatility falls. Again, depending on where you put it on. We're going to talk next week about where falling volatility actually helps you because you capture time decay. Right? So, any other trading, guys? I'm sorry, any other trading. Any other questions? I'm happy to sit here for a few minutes and see if anybody's got any that they want to add. Again, I know a lot of you are probably thinking, well, how do I know where volatility is at? And a lot of it is more learning when to be aware of changes in volatility. And you can actually watch your spread pricing and figure it out. If you see that the underlying isn't moving, but certain spread prices, the prices are falling anyway, then time is coming out and potentially volatility is coming out. If the price is coming out quickly and the time isn't moving as quickly, that's mostly volatility. So there's things you could look at. It's more about recognizing it than it is about having the exact level of implied volatility. But down the road, we're going to have something for you guys with that as well. So, any questions, guys? And if not, again, please go to pathtradingpartners.com. Our podcast comes out every Friday afternoon. So I think we've got about 8 or 9 episodes right now. And then please follow us on Twitter and like us on Facebook as well. Guys, thanks for being here. Chip, Nadex, thanks again. Mike, thanks for fixing the slide deck that I screwed up. I appreciate that. And cheers, guys. We'll speak to you guys next time, next Tuesday as always. Thanks, guys.